Welcome to Teach Wisely. Today we're going to see concept of about provision for bad and doubtful debts. This is the most important concept in final accounts. So if the sum contains old provision and new provision, it will be a little bit complicated for some of the students. So I'm going to put step by step calculation and how you're going to understand easily with small tips and tricks in today's video. So the question is, provision for bad and doubtful debt shows a balance of Rs 1600 on 1st January 2017. So these are all old ones, which means these are all already recorded in the books of accounts. Bad debts during the year amount to 600 rupees. This is the old bad debts, which means it is already recorded in the books of accounts. The sundry debtors are on 31st December 2017 is rupees 16,000. So the debtors value at the end of the year is 16,000. Provide additional bad debts of rupees 100. You have to provide, which means it is a new one. Which is not yet recorded in the books of accounts. Create a provision of 5% for bad and doubtful debts. So this provision is also new, which means you have to create now. Okay, you have to create now, which is it is not recorded it already in the books of accounts. Show how it affects the profit and loss account and balance sheet. So first we are going to differentiate or put separately the new ones and the old ones. Now I'm going to write new bad debts, which is 100. Then new provision, which we are going to calculate with the sundry debtor value. Sundry debtor value 16,000 into 5% if there is no new bad debts. If there is a new bad debts, which means you have to first deduct the new bad debts. 15,900. So these two are new. These two are not recorded yet in the books of accounts. So first the order of putting entry is first new bad debts, then new provision. Bad debts means it is confirmed. You cannot recover the amount from the customer. It is confirmed. Provision means it is doubtful. You may recover the amount or you may not recover the amount. So for the safety, you're gonna create a provision for the emergency if the customer may not paid, or if you cannot recover the amount, you can use the provision to cope up with the loss. So that's why we are creating provisions in final accounts. So 16,000 minus, first you have to deduct the confirmed amount, which is bad debts. You cannot recover the amount, right? So then the debtors will come down to 15,900. I am going to create 5% provision out of this 15,900, which means you have to recover 15,900 rupees from the customer, out of which 5% amount or 5% of the customer is doubtful. You may recover the amount or you may not recover the amount. So which is 795 rupees. So these are all new ones. Then old ones means which are already recorded in the books of account, but you need it for a reference, which is 600 rupees, and old provision, which is 1600. Now what I'm going to do is I'm going to put two teams, okay? Team A and Team B. Team A is a very lonely team. You have only one team member, which is old provision. And team B is a group of people. So all the other items except the old provision will come under team B. So new bad debts, new provision, old bad debts, and this is the team B. So I'm going to total both the teams. Now I'm going to calculate the difference. So 105 rupees is the difference. So next step is where we have to put the difference in the debit side of the P&L account or the credit side of the P&L account. Only one trick is enough. Compare both the team, which has the highest value. If the team A, which is the only team, which means the old provision, if the value is high, which means the total is high, then the difference will come under the credit side of the P&L account. If the team B has the highest value, then the difference amount will come under the P&L account debit side. Okay, if you're gonna remember this rule, you can easily finish off the final accounts, especially this bad debts, old and new provision. Now I'm gonna open up P&L account. So in this sum, we have highest value in the team A, which is the old provision. So I'm gonna put the difference in the credit side of the P&L account. So this is the credit side by provision for bad and doubtful debts, old. I'm going to put the amount in the inner column and deduct everything from it. So new bad debts, so the difference amount 105 will be entered in the P&L account credit side. If the team B has highest value, you're going to put everything in the debit side, which means new bad debts, old bad debts, new provision minus old provision. It will be on the reverse, the reverse format in the debit side. Now I am going to open a balance sheet. So sundry debtors are asset. So I'm going to put everything in the asset side. Sundry debtor value at the end of the year is 16,000. So in the balance sheet, only one trick is to be, or one rule is to be followed. Only the new items will be recorded, because old items are already recorded in the previous year books of accounts. So there is no need for recording it again in this year balance sheet. Okay. So I'm going to deduct only the new ones. So the new bad debts and new provision and the final debtor value will be 15,105. So this value is the final value of the sundry debtors at the end of the accounting year, and this will be carried forward to the next year as opening sundry debtor. So this is how you're going to work out the bad and doubtful debts, especially if old provision and new provisions are involved. If you have any doubts, put your doubts in the comment section. I try my best to address it. That's all for today's video. Thank you.